The housing market feels broken right now. Prices are sky high, mortgage rates have doubled, and entire generations feel locked out of homeownership. But to really understand how we got here and why housing has become one of the most divisive economic issues today, we have to rewind a bit. Let's go back to the 1990s. Back then, housing was still considered relatively boring. Sure, prices were rising, but they mostly moved in line with inflation and wages. A house was a place to live, not a lottery ticket. People bought homes to settle down, raise kids, and build stability. Mortgage rates were still fairly high, often above 7%, but they were slowly trending downward, which made home ownership more accessible to middle-class families. Banks were also cautious about who they lent money to. Getting a mortgage meant proving you could actually afford it. Steady job, clean credit history, solid down payment. And the global financial system wasn't yet addicted to mortgage debt. But as the decade rolled on, things started changing. Wall Street began to notice something. Mortgages, those boring monthly payments, could actually be turned into an investment product. Banks realized that instead of just sitting around collecting payments for 30 years, they could bundle hundreds or even thousands of mortgages together and sell them as investments called mortgage-backed securities. It was a financial innovation that looked brilliant on paper. Banks got their money back faster, which meant they could issue more loans. Investors, including pension funds and insurance companies, loved the steady stream of cash these mortgage bundles produced. And for a while, it worked beautifully. Then came the early 2000s. The Federal Reserve cut interest rates dramatically after the dot-com bubble burst and the 9/11 attacks shook the economy. This made borrowing cheaper than ever. Suddenly, millions of new buyers could qualify for a mortgage. Demand for housing spiked, and prices started rising faster than wages for the first time in decades. This is where the housing market turned into a feedback loop. Rising prices made homeowners feel wealthier, which encouraged them to borrow more or buy additional properties. The more people bought, the more prices climbed. But there was a problem. There were only so many qualified buyers. To keep the machine running, banks started lowering their standards. They created new types of loans, adjustable rate mortgages, interest-only mortgages, and even ninja loans. No income, no job, no assets. Suddenly, people who couldn't traditionally qualify for a mortgage were being approved for homes way outside their budgets. At first, this seemed like a good thing. Homeownership rights climbed to record highs. Politicians from both parties celebrated it as a sign of prosperity. And as long as home prices kept going up, there didn't seem to be much risk. After all, even if a borrower defaulted, the house could just be sold for a profit. Soon, everyone wanted in. Families were buying bigger houses than they needed. Flippers were buying properties to renovate and resell. Hedge funds were buying entire blocks of homes as investments. The housing market stopped being just about shelter. It became a speculative frenzy. By the mid-2000s, it wasn't unusual to see people owning 3, 4, even 5 houses, all bought with borrowed money, betting they could flip them within months for massive profits. Home builders were breaking ground on new subdivisions at a record pace. Reality TV shows glamorized house flipping as the ultimate hustle, and housing prices soared far beyond what most local incomes could realistically support. And then came the cracks. When interest rates ticked back up, adjustable rate mortgages reset to much higher monthly payments. Suddenly, many homeowners couldn't keep up. People who had stretched their budgets to buy at the peak of the market now owed more than their homes were worth. Foreclosures began piling up. What started as a housing problem quickly became a banking problem. Those mortgage-backed securities Wall Street had been selling, they were everywhere. In retirement funds, foreign banks, hedge funds. When American homeowners started defaulting, the value of those securities collapsed. It was like pulling a single block out of a giant Jenga tower. The whole financial system started shaking. Lehman Brothers went bankrupt. Bear Stearns had to be rescued. Major banks were suddenly at risk of failing. The U.S. government and the Federal Reserve stepped in with massive bailouts to prevent total economic collapse. Housing prices didn't just slow down, they crashed. In some cities, prices dropped 30, 40, even 50%. Trillions of dollars in household wealth evaporated almost overnight. Millions of people lost their homes. Entire neighborhoods sat vacant. Construction projects were abandoned mid-build. And perhaps most importantly, the psychology of home ownership changed. People no longer saw housing as a guaranteed path to wealth. They saw it as a risk, one that could destroy your finances if you timed it wrong. Fast forward to today. On paper, we've recovered. Home prices have not only rebounded, but hit new highs. But underneath, the housing market is still scarred. Builders stayed cautious for years after the crash, which means we've been underbuilding new homes for more than a decade. That undersupply is one of the main reasons housing feels so expensive today. Meanwhile, millennials, the largest generation, have finally reached prime home buying age. That means a surge of demand, right when supply is at historic lows. Then came the pandemic. When COVID hit, the Federal Reserve slashed interest rates to near zero to keep the economy from collapsing. Mortgage rates fell to record lows, in some cases below 3%. Suddenly, buying a house was cheaper on a monthly basis than renting in many places. People rushed into the market. Remote work changed everything. People no longer had to live near their offices, so they started moving to cheaper cities or buying bigger homes farther away. This wave of buyers sent prices skyrocketing in places that had never seen such demand before. Austin, Boise, Phoenix. Investors jumped back in too. Small landlords, corporate landlords, even institutional investors started buying single-family homes, seeing them as a safe bet in an inflationary world. Then, in 2022, the Fed flipped the script. To fight the worst inflation in 40 years, it aggressively raised interest rates. Mortgage rates more than doubled in just months, going from under 3% to over 6%, then over 7%. Monthly payments for new buyers skyrocketed. A house that seemed affordable in 2021 suddenly required hundreds, even thousands more per month. And yet, home prices didn't crash like many predicted. Why? Because supply is still incredibly tight. Millions of homeowners are locked in with ultra-low mortgage rates. If you're sitting on a 3% mortgage, you don't want to sell and buy a new home at 7%. That means fewer homes on the market, which keeps prices high even as demand cools. So here we are. Home buyers are frustrated. Renters feel trapped. Investors are cautious but still buying. And policymakers are stuck, trying to fix a problem decades in the making. So what could actually solve this? The most obvious solution is to build more homes, especially affordable ones. But that's easier said than done. Zoning laws in many cities make it hard to build apartments or dense housing. NIMBY opposition slows down development, and construction costs remain high because of labor shortages and expensive building materials.
Until those barriers are addressed, we'll keep having too few homes for too many people. Interest rates are another piece of the puzzle. If the Fed eventually cuts rates, monthly payments will become more affordable and bring more buyers back. But ironically, that could push prices even higher unless supply rises too. Some experts call for a housing reset, a period where prices stay flat or even fall a little while wages catch up. But this comes with risks. Falling prices could slow construction further, hurt local economies, and leave some recent buyers underwater on their mortgages. And then there's the debate over investors. Some argue institutional investors should be limited so regular families get first dibs on homes. Others say investors are part of the solution because they provide rental housing and keep neighborhoods occupied. At the individual level, the key is strategy. If you're renting, weigh whether buying now makes sense or if it's smarter to save, wait, and watch the market. If you own a home, remember that price jobs don't matter much if you're at it for the long haul. And if you're investing, focus on fundamentals like cash flow and location, not just speculation. The housing crisis isn't just about numbers, it's about psychology. It's about timing, patience, and knowing what you're playing for. There is no single fix for the housing crisis. It's the result of decades of underbuilding, financial innovation, demographic shifts, and policy decisions. But one thing is clear. Those who approach the market with patience and strategy have an edge. Whether prices rise, fall, or stall, the winners are rarely the ones who panic, they're the ones who plan. They save, they wait for the right opportunity, and they understand that housing is a long game. In a world where everyone wants quick wins, staying calm and thinking ahead might be the smartest move you can make.